Is there going to be any changes expected to the health reimbursement account or the
in 2000,
health savings account?
Yeah, there is a slight change. There are really two changes in 2011. They're not effective in 2010. They're effective in 2011. Prior to 2000, what they did was they said that distributions from HSAs and FSAs can only be for qualified medical expenses under, I don't want to use a code section, but it's code section 213, which is the medical expense, which is qualified medical expenses for purposes of the medical expense deduction. So what they said was that previous you could buy with HSA distributions, you could buy over-the-counter drugs, Tylenol, other kind of sinus medication, other things like that. What this change says is that because those type of medications, if they're not prescribed by a physician, are not deductible medical expenses, that they're no longer qualified distributions from an HSA, unless you get a doctor to prescribe those medications. So if you get a doctor to prescribe Tylenol or whatever your sinus medication, whatever that over-the-counter medication they used to just go in and buy, take out your card, use your FSA card, you're no longer going to be able to do that with respect to those without a prescription. So it's a little, I mean, I understand the concept behind it. I'm not sure I so understand that they needed to do something like this, but that's where it's at. They also raised the excise tax on on non-qualifying distributions from HSAs and MSAs. They used to be at 10 and 15% of the excise tax regime on, depending upon when the distribution and what type of distribution. It's now at 20%, or in 2011 it was 20% excise tax on non-qualifying distributions. So those are the changes that were made in the area of the FSA and HSA and MSA plans.
The one thing I would just like to share with you a little bit, and this is more of a strategy, but does everybody know what a health, an HSA is? Not really? All right, well, let me give you a little overview, just a simple overview of what it is. An HSA stands for a health savings account. That's what it stands for. And what this health savings account does, it's tied to what's known as tax-qualified, large deductible health insurance plans. So you might have a health insurance plan right now where if you go to the doctor, you're paying a copay, okay? Or if you go get your prescription drugs, you pay a copay. You know, and you might have out-of-network benefits. You know, if you go in-network, you pay a copay. If you go out-of-network, you're going to be subject to maybe a deductible and co-insurance. One of the type of programs that you might want to look at for yourself is the strategy of looking at a tax-qualified, high-deductible health plan. Because if you take a look at the premium that you're paying on your, I'm going to call it traditional health plan, you might be paying $650 a month for a single rate, roughly. If you took a look at a tax-qualified high-deductible plan, maybe a plan with a $3,000 deductible, which is kind of high, your premium for that type of program might run $350 a month. So if you take a look at the difference in premium, you're looking at $650 minus $350, that's about $300 a month. $300 a month times 12 is about $3,600. You're allowed to take $3,000 and actually open up a personal bank account. And that personal bank account is called a health savings account. And the idea is that you're going to use that account rather than going to the doctor and paying co-pays like you were before. Essentially, you're going to be using that bank account to pay for your incurred costs. And what's going to happen, or what you will notice if you decide to use this type of strategy, is that when you go to the doctor, typically you're not going to pay anything under an HSA. And then you're going to get what's known as an EOB, explanation of benefits from the insurance carrier. You're going to pay the doctor or provider the negotiated rate that the insurance carrier negotiated with the provider. So if the doctor normally charged $100, and if you go in network and you buy this tax-qualified, high-deductible plan, and then negotiated rate is, say, $50, that's how much you would pay the particular provider from your HSA account. And again, that HSA account is tax deductible for you. And if it's used for unreimbursed medical expenses, Section 213 comes out tax-free. And essentially, if you don't use it, it kind of accumulates like an IRA until you're 65 years old. So if you're already maxing out on your pension plan, not that we're here to talk about pension plans, here's another way where you could put some dough away, get a personal tax deduction. If you use it for your unreimbursed medical expenses, that's fine, that's what it's there for. But if not, it's going to accumulate until you're 65 years old, and then you can take a distribution similar to an IRA at that time. So it might be a strategy that you might want to look at for yourself personally or for your business to see if it makes sense. And you just want to do the math. If you go to the doctors a lot, you know, depending upon what the difference is on premium, maybe it won't. But if you don't go to the doctors a lot and the difference in premium is there, maybe it will. So it's just something that you want to take a look at. But that's what the HSA is, health savings account tied to from an insurance carrier purchasing a tax-qualified high-deductible plan.
Just curious, the flexible spending plan the same as?
No, the flexible spending plan is a little bit different.
How are they impacted?
Typically under a flexible spending account, you might have a regular co-pay type plan where if you go to the doctor, you'll pay 25 or 50 bucks, and if you go have a hospitalization stay, maybe there's a $500 copay. But under an FSA, what you're allowed to do on a pre-tax basis, you could elect to put away money into an account that can be used, again, to reimburse. But the difference is, under an FSA, everybody's heard that term, you need to use it or you're going to lose it. You know, that's the issue that you have with an FSA, that if you don't spend that money at the end of the year, you're going to lose it. So you have to be very careful on how much you elect to put away under an FSA. And again, under the FSA and the HSA, over-the-counter drugs, you know, your Advils or your aspirins, are not going to be covered anymore. You can't take that, you take the money out of the accounts for that. You got to go to the doctor and get a prescription. That's how it's got to be covered. And again, yeah, that's basically.
Well, you know, I think one of the things that should be mentioned, and I don't know how, you know, many of your businesses are structured. The HSA versus the FSA, partners and partnerships cannot utilize a flexible spending account. However, they can participate in a health savings account. I can tell you in my company structure, we just changed last year to a high deductible HSA. Our partners couldn't use a flexible spending account, and this was essentially, and they were raising our rates 20%.
Yeah, I see what I'm saying.
And so in lieu of that, we lowered our premiums. Our partners were distributed dollars to go into an HSA, and it's actually, you know, if you're not spending it, it works great.
Agreed. And the one point that I would like to share is Arnold is from an accounting firm. And if the accounting firm did the math and it makes sense for them, maybe you just want to take a look at it for yourself.
And also, Arnold used to be with the IRS. Just a couple follow-ups also with...
I'm not that old, and I have 30 years experience.
John was referring to traditional plans. The premium increase is 20, 30. Our plan actually just went up 89% as of January 1st, our premiums. The premium increases, at some point, something's going to break. I mean, it's bending right now. And what we feel is everybody, or the majority of the population, will in some way, shape, or form be enrolled in this type of plan, whether it's an HSA qualified plan or some other deductible or cost share plan, as they're called. This is the way the premiums are dictated, because if you don't go to this type of plan or something similar, your single rates at some point in the very near future are going to be over $1,000 a month anyhow. And that's going to become unaffordable. It's already unaffordable for many businesses now. Secondly, with respect to the deductible, the $3,000 deductible, when we started talking about these plans, I'm sure you have the same experience with your clients. It's scary to say, ooh, 3,000, I'm exposed to that. But when you do the math, number one, it still may be favorable. But number two, there's a couple of other things to keep in mind. Number one, the average single person uses about $400 to $500 of healthcare expenses in a given year. That's the average person. So when you understand those statistics, as a family, I'm a family of 6. Excuse me, the average family of 6 here, Todd Bellistri, we've used less than $2,000 of expenses each of the last 5 years. I've tracked all of our expenses. I have little kids. I've been at the emergency room at Huntington Hospital a number of times. Still, we spend a very small amount, and part of that is, knock on wood, we have no chronic issues. But also, as John had mentioned, the negotiated rate is significant. We had a bill from the hospital over $6,000. The negotiated rate was in the neighborhood of $800. So you're still getting that benefit with these high deductible plans. And then lastly, if I may, with the healthcare reform, there's been an expansion, as was mentioned earlier, of preventive care services. So even if you have a high deductible health plan, that notwithstanding, if you're going in for your physicals, the kids are getting their immunizations and all these things which are considered preventive care, all of those services are covered 100%, not subject to deductible.
And while you're talking about the preventative care, once again, if that's part of a health plan for an employer, do those costs get passed on to the employer? Who's going to pay? In fact, that's a larger question after. Who pays for all this?
You mean the preventive care being covered?
Yeah, with that being now a feature where they don't have to, people don't have to put money out, who's paying for that?
Well, John mentioned earlier in speaking to carriers, the preventive care provision and the age 26 adult child, that's estimated, that's adding about 3 to 4% to our increases here. Is it really free? No, but it's built into those increases we're seeing. And, but at the time of service, it's no cost at that point.
You know, one